Alright team, we're back. So these are the year 15 decisions for the business strategy game. And what we decided to do this year is a little bit different. So I'm not sure. Let's start off with the market snapshot here. So where we're at right now, we have the second to lowest market share in North America. We're selling our shoes for a bit more than the industry average, as you can see here. And we're not really that worried about it. We're spending the least amount in advertising in North America. We've increased our advertising spend this year. We did a really low bid in private label, trying to scare everyone out. But last year, nobody bid in the private label market. It was really just us. So we could have gone after monster profits in this market. We could have gone after monster profits in every market. We just didn't know that at the time. So we're just kind of keeping an eye on everyone's strategy and what they're doing. As you can see, just from where we're at, Company C is really dominating North America. They're making the highest quality shoe, and selling it for not much more than everyone else. Now, we did pick up some sales due to stockouts last year. I don't see that continuing per se, because Company B did build a lot of capacity. So we'll talk about that here in a minute. Where we ended up with Europe. The Company B had a stock out, so we ended up picking up just a few sales from that, not a whole lot. And again, we made a very low bid in private label, but nobody bid in private label. So where we're at in Europe is we have a bigger market share in Europe, and it's nice, but we're not making the profits that everyone else is. As you can see, we're below the industry average in Europe. So we're also heavily advertising. So that's really increasing our costs in this market, and we're not making up for it selling for a higher dollar amount. Now, we are trying to increase our quality in Europe, so we're going to start kind of moving closer to these guys in terms of pricing, and if we can maintain a decent market share, that will improve our profitability. In Asia, this is really a hotly contested market, and so much so because everyone started the game with production in Asia, so everyone has the ability to produce in Asia. No one has sold their Asian capacity, so everyone's still producing in Asia. It's just a really tight race. Now, we're at the industry average in Asia. Company B decided to lower their price, but they also have lower quality. We're still increasing our quality, so we'll move up to 8 quality here. We've got more models available. We're doing heavier advertising, but we're still not the market leader. We're actually, lagging behind everyone else. Part of that is due to Company B's celebrity appeal. They're spending a lot of money on celebrities, so they have that working in their favor. And part of it is pricing. So they're lower priced than us. Their quality is not that far off from ours. And they have a lot of celebrity appeal. They also give a lot of retailer support. So there are a little bit more retail outlets. Their shoes more widely available, so people pick them up more. It's just, it's like I said, it's hotly contested here in Asia. So we're hoping that our differentiation strategy is going to help us out. We'll keep increasing our quality. We have more models than everyone, and we're hoping that's going to start to give us the edge. We also have some celebrity appeal, so we'll see what happens in this market. It's just it's a tougher market. We need to figure out what it is we're going to do. As you can see, the market share and the strategy as far as where we're at on the map is it's pretty close. It's pretty tightly. We're really close to Company B, and we need to start moving away from them. We still don't know if it's going to gain this market share, so we'll see what happens. In Latin America, we are the price leader. We have the most capacity in Latin America, although Company B did build a lot of capacity in Latin America starting this year, so we'll see what happens with that. When it comes down to just market share, as you can see, we're the leader. We're also the price leader, so it's not, it's no wonder that we're the leader, and we also heavily advertise. So, we're really paying a high cost to be the market share leader here, and we're making profit, but we need to figure out whether it's worth it to keep our price this low, especially as we move to higher and higher quality. But our goal was to be the leader in Latin America. So when we built the plant there, that was our particular goal. So we need to assess the the viability of that goal and the profitability of that goal to see if we're going to move forward with it. Now, with the private label, we did really well. We did really well this year with private label in Latin America, and it's really informing our private label strategy for this entire year. So, what I wanted to show you was our plan for this year. What we decided to do was since we sold our North American production, we don't have the ability to produce as many shoes. If you look at our wholesale marketing, we don't have we're barely covering our inventory requirements. If we meet our projections, if we meet our forecast as far as sales, we're gonna have stock outs. We might have a stock out in Europe and Africa. We might even have a stock out in North America. In North America, we have excess inventory. So because we have excess inventory that we're trying to sell through, we're not sending as many shoes there, but we have less than what we're projected to sell. So it's both a good and a bad problem to have. The other big thing that we're doing with private label this year is we are increasing our prices. As everyone can see, we're really trying to go for a max strategy, and the reason being is because everyone else's capacity is taken up selling in the wholesale market. So as you can see, last year, the other companies, they didn't go into private label. They didn't go into private label for two reasons. One, the year before, we undercut everybody and just really hurt. We just put the screws to everybody. So everyone's earnings per share went up when they got out of private label last year. But also, they don't have the production. Company B sold their North American production. So they're producing in Latin America and in Asia like we are. And Company C, they still have the North American production, but they didn't build a plant in Latin America like we did. So both companies are constrained as far as their capacity goes. They can't produce enough shoes to meet all the demand. And we, as you can see, we have the most production. Company B built an additional 3 million pairs of shoes of production last year, so they'll be able to take advantage of that. And I'm guessing they built that in Latin America or between Latin America and Asia. Company C, they built 1,000 units of production. I don't know where they built that. It could have been in Latin America, could have been in Asia, could have been in North America, could have been in Europe. I don't know, but it's not a whole lot of production. So when it comes to what they can produce, they can't produce enough to lock up the entire market. If you look at the private label operations, the private label demand, we're not even able to meet the private label demand, right? Company B, they've got a slight edge on us as far as production. Maybe they can do 700,000 more shoes than us, which would allow them to take up one entire market, maybe a market and a half, 2 markets at the max. So even if they do all of their branded production and they go into private label, they can only either split the baby between all 4 markets like we are and take half the market, or they can go heavily into 2 markets, which means we'll lose our bid in 2 markets and we'll make our bid in 2 markets. So either way you look at it, going with a mixed strategy, going half in the market, kind of hedging against the market, and keeping our prices about as high as we can to maximize our return. In the private label market is really what we decided to do. So that was our strategy for this year, based on the capacity that we believe everyone has and what we believe that their strategy could be. Not what it's going to be, what it could be. Like, they don't have the ability to do anything else. Now, next year, we're believing that they're going to have more capacity. So we're believing that next year there's going to be a surplus of capacity, surplus of production, and that could start to drive prices down. So we need to determine what we're going to do with our strategy next year. This year, though, we don't see that being a problem, and we just want to take advantage of where we can, as far as what the other teams are able to do and what we see them being able to do. The other couple of things that we decided to do this year is we have a low bid on celebrities. Celebrities are great, but they're not going to make or break our strategy. I don't really see us. We want to make sure that our celebrities that we get are profitable. So we don't want to overpay for them. We don't want to drive prices up too high for the celebrities because it just doesn't make sense. It doesn't make sense to have $20–30 million tied up in celebrities when we could be using that indirect advertising and the retailer support, which is more important for our strategy. So I'm trying to think of what else we did. We were buying back some stock for sure, borrowing some money to be able to do that. And is there anything else I need to show you guys? I don't think there's anything else that I need to show you. So we're gonna call it a wrap.